Hi, my name is Rajat and welcome to Rock with Options, a show for all your option needs. This is the show where we talk about option strategies, mechanisms, adjustments, risk and reward. We also take it one step forward and combine concept with real-time trades to ensure that the understanding is more complete. Today we're going to talk about a very simple intraday Nifty strategy that can be employed on a daily basis to generate some income. This is a very popular strategy, and so we're going to discuss, share our thoughts, our insights, and some backtesting data to showcase the benefit of the strategy. Before we get into details, let's look at what is a short straddle. Short straddle is selling both a call option and put option for the same expiration and the same strike price for the same underlying. Say for instance, selling a call option and put option for the strike price 17,300 for the month of February qualifies as a short straddle. The payoff chart is very simple. As long as the stock does not move beyond the total premium collected, the outcome is positive. So in this case, we collected a total premium of 190 rupees, 100 from the put option by selling the put option, 90 rupees by selling the call options. So as long as we are within the range of 17,110 to 17,490, the short straddle will yield positive results. So our daily Nifty intraday short straddle, what does the mechanism involve at the high level? First, the margin requirement is 1.3 lakhs per lot. The mechanism itself involves selling at the money weekly options. So you sell at the money weekly straddle, so that is both the call option and the put option. What is the goal of it? That we will pocket the premium, decay in premium that happens during the day. We obviously place a stop loss, which is 25% of the premium collected on each leg. Now let's get into the details. So here's the detailed mechanics of this particular strategy. We execute an order at 9:20 a.m. every single day. The option that is sold is the closest ATM, closes at the money, call option and put option. We sell a straddle, so we sell closes at the money weekly call option, closes at the money weekly put option. Say for instance, if Nifty is trading at 17,111, the closest at the money option at the money strike price would be 17,100. The stop loss is placed on both the legs. The stop loss is placed at 25% of the premium collected on each leg. So in the previous example, we collected 100 rupees by selling the put option. So the stop loss for the put option is 125 rupees. For the call option, the premium collected was 90 rupees, so the stop loss is 112.5 rupees. When do we exit? At 2:30. If the stop loss is not hit by then, we manually exit the legs that is still active. So it's very simple. You enter, execute the short straddle at 9:20. Any active legs at 2:30 is manually exited. Now let's look at the payoff charge to better understand this particular strategy. We're going to analyze each scenarios and the outcomes of the same. The payoff chart that's here is for the short straddle. Obviously, we're going to put stop losses on either side. Now let's look at the scenario number one. All right. So the first scenario is Nifty remains range bound. So as a result of which you don't hit any stop loss. There is obviously a theta decay, assuming all Greeks remain the same. You pocket the premium decay. So that's a good situation to be in. Scenario 2, it's a volatile market, so both stop loss get hit. So Nifty moves erratically upward and then turns back and does a U-turn and moves downward, as a result of which both stop losses are hit. Remember, the stop losses are 25% of the premium collected. So you lose 25% on a day when the market is very volatile and swings on both sides. Scenario 3, upward movement. If the market moves unidirectionally upward, right, the C stop loss has hit. There is a significant decay in the P leg because of this movement. Usually when the stock moves up, VIX drops, theta decays, and obviously the profitability of this particular situation depends on the swing in the market. But again, usually more often than not, it works in our favor. Scenario 4, if the market moves downward, again P stop loss is hit, the C leg is now in the money. Usually VIX rises, but there's a theta decay. Again, the profitability depends on the swing in the marketplace, but more often than not, what we have observed is it works in our favor. So this is each of the scenarios. As you have seen, there is one clear winning position, there's one clear losing position. Scenario 3 and 4 depends on how big the swing in the marketplace is. Now let's look at a live example and walk through the outcomes of this particular trade. This morning around 9:20, Nifty was trading very close to that 16,400 mark. That means one would sell a short straddle at 16,400. So you would sell a weekly 16,400 put option and weekly 16,400 call options. The premium collected is on display. Now we go and place the stop losses. Remember, stop losses is 25% of the premium collected on each of the legs. Once we have the stop losses, we can estimate the levels, Nifty levels at which each of these stop losses gets triggered. When Nifty is trading very close to that 16,100 mark, the stop loss on the put side gets triggered. And while Nifty is trading very close to that 16,700 mark, the stop loss on the call option gets triggered. Here we're going to make an assumption that VIX remains constant throughout the day. Obviously that is not the case in the marketplace, and we are going to do that so that it simplifies our analysis and we can get a better understanding of the outcomes. But VIX or volatility, if VIX or volatility increases after the short straddle has been executed, you will see the negative impact on the P&L. The reverse is also true. If VIX or volatility drops after the short straddle has been executed at 9:20, you will see it has a positive impact on the outcome and further enhances the profitability. With that in mind, let us look at the various scenarios and the outcome. Scenario 1, Nifty is range bound and trades within a small range, as a result of which neither of the stop losses gets triggered and theta decay comes into play, and the net P&L is positive. Scenario 2, there's a massive swing on Nifty, right? It triggers the stop losses on both sides, as a result of which the net P&L is negative. Both of these scenarios is fairly straightforward. Let us look at scenario number 3, a strong trend day. It could be both on the positive side or on the negative side. In this example, let us look at it on the positive side. So Nifty goes past that 16,700 levels. So it would basically trigger the stop loss on the call option side. However, we will see a significant decay in the premium of the put option due to the strong movement in Nifty in the positive direction. So the gains on the put option would offset the loss that one has booked on the call option. So the net P&L in all probability will be positive. Scenario 4, a trend reversal day. So Nifty started at around 16,400, hit a high of 16,750 and retreated back to 16,450 levels. Again, in this case, the stop loss on the call side gets triggered. there is a premium decay on the put side. However, the gains on the put side in all probability will not offset the loss one has booked on the call side. So net P&L would be negative. Again, we have simplified some of the factors so we get a better understanding of the outcomes. I hope this helped give you a better idea of the trade, the setup, and the outcomes. Now let's look at some back-tested results. It is critical to see how this strategy has performed over a long period of time. I myself have executed this strategy over the last 14-15 months, and the outcomes have been very positive. But let's look at some back-tested results for the last 3 years. The win percentage is very healthy, 63%. The average profit per day is 1,771. Average loss on loss days is 1,800. But since we win more days, that results in net positive outcome. The overall profit over the 3-year window is close to 3 lakhs. Remember, our margin requirement for executing this strategy is 1.3 lakhs. Max average profit per day is about 402. Max profit is close to 15,000 rupees and max loss is close to 8,000 rupees. Winning streak is 13 days and max losing streak is 5 days. It is critical to remember the max losing streak as well as max loss. You should be able to stomach, you should be able to not worry if you're on that losing streak, and you should not be too worried when you see a huge loss in the range of 7,000, 6,000. That I'm talking about per day losses. Now let's look at the monthly report. If you look at the outcome, right, we've seen there are several months in the year where the returns are negative, but overall what we've seen is it's the fairly consistent return. The annual returns are fairly consistent, close to about 1 lakh. Remember, the margin requirement is about 1.3 lakhs. So net return on a annual basis is about 80%, which is really good. Obviously, the back-tested results are done on a software where there are no slippages and very highly accurate. So even if you account for some of the systemic challenges, you should be able to see somewhere around 75 to 80% gains on an annual basis. Two critical things to note. See, some months the returns are very steep in the red. So in November 2020, the returns was minus 11,000. Also note the max drawdowns. This is the drawdowns from the peaks, and in 2021 the max drawdown was close to 32,000 rupees. Now that we have seen the positive outcomes of the strategy, we have analyzed the scenarios, and we have seen the profitability of the trade, it's only fair to assess the risks involved in this trade. One has to be mentally strong to execute this trade. See, this is a very systematic and a mechanical trade. You enter at 920 and you exit at 230 if the legs are still alive. During this time, if the market is volatile, you'll see your P&L swing from positive to negative, negative to positive, and there's a human tendency to close the trade when you're in the money. I suggest that you avoid that. The other factor is the max loss is about 8,000 rupees. So seeing a loss of 4,000, 5,000 on a day might not give you the mental peace that you desire. Same thing with max losing streak, or if you see a losing month, a couple of losing months, that could impact your psyche. So we have shown you the results. We have shown you some of the back-tested data. If you employ this strategy over a long period of time, you should see positive outcomes. Second is SL, stop loss slipping. This is more of a systemic issue and to a certain extent trade issue as well. Sometimes the price of the option jumps over your stop loss, so the stop loss never gets hit, and you will see that particular leg is deep in the money. What we suggest is, although this is a mechanical and systemic trade, we suggest that you keep an eye out on all your trades and ensure that this stop loss slipping does not happen. Also, while entering the trade, make sure you use basket orders to ensure that you sell both the put option and the call option at the same time. The last thing is the drawdowns. We've seen the numbers earlier. You need to be prepared for it. If you are well in the money, these drawdowns does not have a huge impact, but you start off and you start seeing a drawdown for a couple of months, again will have a huge impact on you. So you need to be prepared for these drawdowns, and again, keeping a long horizon, a long time frame in mind, the outcomes are positive. To summarize, this is a very simple, mechanical, daily Nifty trade. There are no active adjustments. So it's like I said, it's a very systemic trade. It's a high probability trade, right? 63% is the win rate, which is fairly good. Margin requirement is about 1.3 lakhs per lot. What you need to watch out for, especially for new traders, is the drawdown. If you like what you watched, do subscribe to us. If you have any queries, post it. We would be very happy to respond. Again, thank you very much for watching Rock with Options.